How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group and RetireSharp.com. Today's topic, I want to discuss with you annuity quotes and explain them as simplistic as possible. Basically, what's happening is a lot of times an individual receives a quote, an illustration, and they think that that's the greatest thing since sliced bread. They don't truly understand what it means, where you could kind of read between the lines and see the fluffed up projections that insurance companies try to do. So what I want to do is kind of expose some of the things on how to read between the lines and see whether or not something has a contractual guarantee, how good of an actual product it is with a worst case scenario basis to determine, whether or not you should throw any dollar amount in there, let alone your entire life savings, your entire retirement savings into it, because many times, they're explained the wrong way, and then advisors are able to fluff up these projections so that somebody kind of has that bait and switch, get hook, line, and sinker into getting set up with a contract. So, 'cause some of the things I'm going to go over is the different types of annuities, really briefly, the biggest problem when receiving quotes, and then this part, I don't mean to offend anybody with any curse words, but read through the BS and find the cash flow. So to get started, types of annuities. Now we understand that annuities are types of products, types of retirement products that are set up through insurance companies. So only insurance companies could offer annuities. You've had other types of annuities in the past that a lot of individuals mistake for the annuities of today. So please be mindful that there were innovations, there are constant innovations from the 1990s, early 2000s, after 2008, after the downward market crash. So they have a whole slew of different things on how they're tweaked properly for an individual situation, and how you could leverage an actual a contract or an annuity contract specific to your needs. And all that means is it's set up through an insurance company. Insurance companies are the only ones that could offer annuities, just like a certificate of deposit could only be offered through a bank. Annuity contracts could only be offered through insurance companies. The first very easy type of annuity is the fixed annuity. I typically like to see these things known as MIGAs. So what this says is kind of just like how if you understand how a bank CD works, where let's say you have a 5-year bank CD that's paying you, right now 1% per year. Obviously it used to be much higher in later, in earlier years. But what this would say is essentially if you have a bucket of $100,000 and you have a bank CD that pays you 1% per year, but after the first year you're getting $1,000, second year $1,000, third year $1,000, etc. So individuals are able to leverage fixed annuities with the same sort of concept. They like the safety of banks. They like the safety of a legal reserve structure like an insurance company can provide with these types of fixed accounts, but they want to have a better return on their money. So, if a typical bank CD is paying 1%, typically the MIGA, that fixed annuity, is paying, in between 2 to 3%. So it's going to be, about 2 to 3% higher than what current bank CDs are getting paid. And they're all going to be tied to interest rate environments. So even right now, MIGAs are pretty low, bank CDs are pretty low. So if you ever get an illustration, there's a couple of things that you want to make sure that or an annuity quote on this, you want to make sure that if they're giving you a specific dollar amount, like let's say $100,000, and it's set up to a 5-year MIGA, you want to make sure if the first year they're paying you 3%, that every single year after that is going to get paid 3%. You want to have that flat amount of interest credit in there. Many times you have these types of annuities that they might pay you like 4% the first year, get somebody in there, and then all of a sudden reduce that rate down to what they feel is necessary, which could be 1%. And now that person's handcuffed into that contract for the next 5 years. So the first type is the fixed annuities. You just want to make sure that you're reading through those lines. The variable annuities, you have different things with variable annuities. I talk badly about variable annuities. I don't like them. I typically think that they're posed as something else. They're trying to be a mutual fund, and they have mutual funds invested in them. They're trying to be an income product, and just kind of the blend is not a good thing. It's kind of like one of those half boats, half cars. If you ever go to amusement parks, or I think they have them over at Busch Gardens. We're located over in Tampa, Florida, so we got Busch Gardens over here, and there's this thing that is basically, it drives up and like the safari, and then it goes into the water. So it's kind of a boat and a car mixed. That's what I think of a variable annuity is, it's not a good investment product and it's not a really good income product because you have a lot of hidden fees. Sometimes it could work out well if you got set up in about 2006, 2005, depending upon what those income riders were that you attach them to that product. But essentially, when I go through how to figure out the cash flow, you could see how the hybrid annuities have actually been a lot better than what the variable annuity rates are right now. So I'll expose that a little bit later. And then you also have index annuities, where this correlates to the hybrid annuity. A hybrid annuity is simply a fixed index annuity with an income rider. And the way that income rider is displayed is where you see a lot of these problems. So what I'm actually going to do is go through an example off of an income account, off of an income rider, and actually show you how to expose that cash flow so you could compare one company to the next to determine whether or not it's going to be the best for your specific situation, the best for however long of a deferral you want, whether that's a 30-day deferral, whether that's a 5-year deferral, 10-year deferral, and how to really find, read through the lines and get the exact percentage, the exact cash flow, for your specific situation. So when you're looking at the hybrid aspect, always think of income rider. So if we understand with a fixed account, kind of think of this like a bucket, okay? We have a fixed bucket, we have a variable bucket, and then we have an index bucket. Let's say you have $100,000 in all of them. Now, let's say the market gains 10% the first year, and then it loses 10% the next year. So what exactly, let's say the fixed account is paying you 3%. What this means is if the market went up 10%, well, this bucket is going to get 3%. If the market went down 10%, this bucket's going to get 3%. It's going to be a fixed percentage amount on the specific MYGA that you choose or whichever carrier. As long as they're paying you that fixed percentage rate, it's going to remain fixed for the length of that time for as long as you have that contract. Very simple. This bucket, if you receive a gain, and it's variable, and let's say after all the fees and all that, you get a 10% gain into that bucket. They'll open up the lid, pour 10% inside, and now you have a larger account. The next year, if you lose 10%, well, now that's obviously going to be a larger loss because it's going to be a 10% downward shift plus any sorts of fees, and this bucket is actually going to be further reduced below the $100,000 mark. You would actually end up losing because 10% of $110,000 after the first year would be $11,000, and then $11,000 would get deducted off of this $110,000, so therefore you're actually going to be left with $99,000. So when you have downward market losses and then you also have a fees associated with variable, understand it's going to go up when the market goes up, go down when the market goes down. The index, let's say if you had something like a 7% cap and the market gained 10%, well, you would gain, kind of think of this bucket with a lid over it, you would gain 7% into that account. Let's say the next year when the market loses 10%, well, you have a floor. That's the importance of indexing strategies. That's the importance of index annuities. So this is the generic. This is how the account value, this is how your physical money works before you attach an income rider onto it. So I hope that all of this makes sense. Please review this section if that doesn't make any sense. Now, so when we're regarding hybrid annuities, what's happening is you have that account value side. So if you had a fixed annuity with an income rider, your account value would be doing exactly this dance. The income rider might give a specific guarantee. Variable annuity with an income rider, the variable account side will be doing that specific dance, and the income rider is going to have specific guarantee. That index account value is going to be doing that exact dance, and the income rider is going to give you a specific guarantee. So if we understand this, what exactly is this income rider? What exactly is this income base? How exactly does it compare? So this section, I'm actually going to bring up a PowerPoint slide, and I know how much you guys love my sloppy handwriting, so I apologize to disappoint anything, but yes, this is actually going to be able to break this down very simplistic. What this shows us is an income-based side, right? Understand, whenever you see a guarantee, that's not your true money. That's nothing more than a calculation account, okay? Calculation account. So if you have company A that's giving an income rider with a 7% guarantee, and you have company B that's giving an income rider with a 5% guarantee, what exactly does that mean? And we're just going to use simple interest so that it's really easy to do the math and you can see it side by side. If you're looking at this, and let's say we have a person, a male age 60, that's looking to trigger income at age 65, how can we figure out what the cash flow is? Well, on the surface, you say 7% is higher than 5%. So, company A looks fantastic. All day long, I'm going to go with company A. First year, this income base grows to 107,000. Second year, 114. Third year, 121. Fourth year, 128. Fifth year, 135. As opposed to company B, after the fifth year, it's going to go to 125. So understand, whenever these companies are trying to provide you lifetime income, the reason why they're doing an income rider as opposed to annuitization used to be the old school annuities, right? So what happened was an individual would surrender their money, their $100,000 to a company, and like this individual would say, I'm age 60, I'm going to surrender my money, $100,000 to the insurance company, and they're going to give me a specific income guarantee at age 65. Well, when we use an income rider, instead of annuitization, you're not surrendering your money. You're allowed to still have those monies into that account value that I spoke about, whether that's in fixed, variable, or index. You're able to still have that account value, that your physical money grow when the market goes up, not lose when the market goes down. And you could attach this income rider so that they're going to be able to determine how much lifetime income you will receive. Kind of like how annuitization works, except for you're not releasing control like annuitization does. So what I mean by that is if you see company A versus company B, you're saying, oh, company A all day long. This is 135,000 on my income base. This is 125,000. Once again, this is not your real money. This is a calculation account. The way then how it determines how much lifetime income the company's going to pay you is going to be your income base multiplied by your withdrawal rate percentage, and that's what equals your lifetime income. So let's say company A has a withdrawal rate percentage of 4%, but company B has a withdrawal rate percentage of 5%. What exactly does that mean? Well, that means company A is going to be, at age 65, they determine that their withdrawal rate percentage is 4%. Company B at age 65 male determines that's going to be 5%. So when we actually do the calculation, 135 multiplied by 4%, 125 multiplied by 5, your actual numbers, and I hope that you could read this, is $5,400 with company A and $6,250 with company B. So what that tells us is that company A is a much crappier product than company B. If we're looking to get the lifetime income, the best lifetime income out of this, well, we understand that out of the $100,000 deposit, a 6.250% cash flow is with company B as opposed to a 5.40% cash flow with company A. So therefore, there's no reason to go with company A over company B unless you had a better rating and this was just a generally better company. You could kind of pick your poison on that route. But if you're looking specifically for a cash flow side, this individual could throw $100,000 and get a much higher cash flow percentage with this 5-year deferral with company B. So I hope that all of that makes sense, guys. This is so important to understand because this is how you're able to weed through whether a company that's telling you, oh, we're going to give you a 7% guarantee, or a company that's saying we're going to give you a 5% guarantee, what that actually means. So in this example, let's say if, at this point in time, the $100,000, we understand we have the account value side, we have the income base side. This shows our income base. So maybe at age 65, his $100,000 grew to let's just say it was 110,000. No real good growth, 110,000. And then they decide to pull out. So we understand the income base at age 65 is 125,000. Well, they're going to go off of the income base multiplied by the withdrawal rate percentage, $6,250. So anytime that they're taking a withdrawal of $6,250, it's going to deduct this off of the account value side. So therefore, it's going to be less. So if your account value gains when the market, like an index, like a fixed index annuity with income rider, it's going to gain when the market goes up, not lose when the market goes down. But you're still going to have to, if you have an income rider, most of the times they have an income rider fee, which will be a negative, typically less than 1%. And then also if you're taking a withdrawal, that's going to be a negative as well. So the longer and longer that you're living, well, yes, you have potential for this account value to grow. You're not annuitizing your money, and let's say if this eventually hits $0 because you keep living so long, well, that $6,250 is still going to be coming into your pocket at the end of the day, and that's the importance of the income rider. You're leveraging the contract exactly how it's designed. You're not trying to get this random 7% guarantee or 5% guarantee that does not exist. This is figuring out the true value of the contract, the true cash value of the or cash flow of the contract. So I hope that made a lot of sense, guys. It allows you to read through the BS, find the cash flow, figure out the best way. Now, we're an independent agency. Like I mentioned all the time, we're 24/7 customer service. You give us a call mornings, nights, weekends, holidays, whatever the case may be. Someone will always be there to take your call. What we try to do is help you figure out whether you want to have an income need, what your situation is, how you got to your situation, do you have certain flaws with your plan, and what do you want to accomplish? So we leverage a whole slew of carriers. We leverage a lot of annuity contracts, pretty much any contract possible in your area, limited to like Alaska, and there's a couple other states that we don't cover. But, for the most part, we want to make sure that any dollar you're placing into a plan, you're educated properly, you're not getting caught up in the fluff, caught up in those numbers. You could actually control, you could set up a specific product and a specific strategy in tandem to make sure that you're accomplishing your goal successfully using the smallest amount of dollars and only as much as necessary out of your retirement savings to accomplish your goals. We also have a bunch of free ebooks. So give us a call at any time. We just set up a whole slew of them. I think we have about 7 or 8 new ebooks out there. So give us a call if you want to have, if you want to have access to some of those where you could expose the cash flow. We have, a whole slew of them, basically how to compare the top annuity contracts, how to expose some of the annuity quotes. We are A+ rated on the Better Business Bureau because we believe in education first. Education, understand exactly what you have, where you want to go, how to get there properly, and we'll walk you through it step by step. And at the end of the day, if you guys just want to have a second opinion, maybe what you're doing is absolutely perfect. But with retirement, what I've learned time and time again with just seeing these retirement disasters is you only have one chance to get things done correctly. What we want to try to do is be the honest advisor, the ethical advisors, give you free education, free content. And, if you like what we have to provide you and you want to get set up with certain plans, obviously that's what we're here for. We have affiliations with all the top carriers, all the top products, and we can help you guys out. But I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks so much, guys.